Time for the market report. Prices looking up.
A surprise, actually, especially in soybeans and corn, finally seeing some relief, some bullish relief. We'll talk about that and more. But first, the numbers. What were the week's biggest gains and losses? And then, row crop prices seeing some upswing. What's the reason for it and will it last? And finally, we sit down with MSU livestock economist Josh Maples to get an idea of what the cattle markets look like. So, markets closed the week on the upswing, both row crops and livestock getting gains. Let's take a look. Last week's biggest gain, sugar, up over a cent, and over 5.5% increase from the previous week. The week's biggest loss, lumber, down 12.5 bucks, a near 2.5% decrease from the previous week. So the biggest story of the marketing week was the last second rise of grains, namely soybeans and corn. This follows weeks of slow activity. So, what was the cause and will it last? I took a closer look at the situation to find out.
Soybeans have seen the largest gain in futures prices since early July. This follows nearly a month of losses, seeing the lowest Friday closing this year of $9.57 on August 16th. It's in stark contrast to prices just 3 months ago, when markets closed on about $12.50 on May 24th. So, what caused this turnaround and how long will it last? According to Carl Setzer from Consensus Ag Consulting, demand for U.S. commodities has grown over the past week, this appearing to stem from weather issues, namely drought, as we continue to transition from El Niño to La Niña. Mississippi has also seen some of these drought problems. Mr. Setzer added further, suggesting the dry conditions in South America have caused traders to consider potential lessening crops from Brazil next harvest season. In addition, soybean oil has been given a boost as an energy alternative from OPEC. Soy was not alone in these gains. Corn came along for the ride, seeing its prices rise for similar reasons. However, due to an abundance of stocks, it was more limited. Time will tell if ongoing weather issues cause these stocks to lessen.
This week in our cattle update, another look at last week's cattle on feed report released by the USDA. I spoke with Dr. Josh Maples from MSU Extension about the details and what exactly did this report tell us. He said there was more to the story than meets the eye.
Quite a bit to dig into on this one. The overall headlines that you typically see are, placements compared to last year's placements and overall inventories and marketings. The placements number was interesting. Placements compared to last year were up about 5 or 6%, which wasn't unexpected, but it did kind of stand out a little bit. One thing to consider is the placements during July last year were actually pretty low for the year, so we were comparing to a lower number. I really like to dig in looking at kind of averages across time because there's so much seasonal variation, and depending on what weather's doing, or especially drought is doing, you can see variation from month to month. If we look at the past 12 months, look at the averages of it, we have seen placements are down about 1 to 2% from where they were the previous 12 months. So you can kind of look at this longer term decline in placements, which should be expected given that we've had smaller calf crops the last couple of years. Meanwhile, the actual inventory of cattle sitting in feedlots, again, averaging across months rather than looking at the snapshot, we've seen that inventory in feedlots has remained relatively the same. So fewer cattle going in, even though we're seeing similar inventory numbers on average.
Well, how has that happened with inventories remaining relatively the same even though placements have declined?
Yeah, I think that's one of the really fascinating things about the current environment that we're in. So we know we have fewer calves hitting the ground. We've got fewer calves that are ultimately going to work their way into feedlots that are produced here in the U.S., but we're keeping cattle in feedlots longer. So we've seen this feeding periods stretch out longer because of what the market is doing or what the market is giving in terms of incentives. We've got relatively cheaper feed than we've had. You've got higher cost for feeder cattle coming into feedlots. And so what we've seen is fewer cattle coming into feedlots, but then they stay longer. And so these overall inventory numbers, they remain kind of elevated or at least not changed from a year ago or from the previous 12 months because they're staying longer. And that is also what's driven these higher dressed weights. We've seen cattle weights whenever they go to processing are much higher or have been much higher through a lot of this year than they were in the previous year. And so this is the market really adjusting, really kind of rationing out the supplies that we have. And we're seeing this play out through these feedlot data that we get each month.
Well, are we still seeing high amounts of heifers coming into the feedlots, or are we actually seeing cattle expansion happening?
Yeah, I don't think we're seeing expansion yet. And in this particular report, we can't dissect steers and heifers particularly, but we can look at other sources of data, and continue to see from the quarterly reports that we get. And the next one we'll get will be the October one. We'll show the split. Well, we're continuing to see a pretty high share of heifers on feed. Some of this could be from imports of heifers. So we bring in quite a few feeder cattle from Mexico, and those imports have more than doubled from last year. They're still not a huge percentage of the overall total, but they are higher, and a lot of those are heifers. So we're seeing some of that play out. But overall, I'm not seeing anything to suggest any widespread herd expansion just yet.
And that's it for a deeper look into the markets, despite slight gain in grain prices still on the lower side. Meanwhile, cattle the bullish markets right now.